Coming up on 8:45 now, this week saw interest rates jump to their highest levels in nearly 23 years. The average rate of a 30-year fixed rate mortgage, 7.48%. They were 5.5% about this time last year. Some thoughts on how this is impacting the housing market from Ernie Burns with Burns Wealth Advisors. Good morning to you.
Morning.
I mean, I ran some numbers this morning on 7.5 versus 3.5 on a $200,000 mortgage. It's $500 a month.
That's a lot.
And that's not counting if you lump on the taxes and the insurance. It's pricing some people out of the market.
That's it. New home applications, the lowest they've been since 1995. And think about it, nobody wants to buy a home and refinance it at 7-8%. So therefore the housing market has slowed down. There's not many houses for sale.
Well, the other thing too, Ernie, is you know, I was talking to someone recently who's ready to buy, has the income to buy, but can't buy because they can't find somebody to get their house, or more importantly, they can't afford to sell their house as they could have years ago.
Real estate market's really slowing down. That's affecting banks and also affecting the economy greatly because people are not borrowing as much as they used to because they can't afford the rates.
The flip side of this, for people who are investing in bonds or CDs, is that there's a better return than there had been.
Yeah, if you think about it, a 2-year treasury right now is paying 5%. CDs are paying 5.5. I mean, now you're able to make a little bit of interest on CDs. And fixed rate income products like fixed annuities are the highest caps they've been in 10 to 15 years. So there's different places to put your money at right now with fixed income, and which we haven't had in 30 years.
In 1980, I think the mortgage rate capped out in the 15% range in the early 80s. I mean, we're not getting near that, but what do you think the cap is?
Well, because I think we're there already. I think with inflation coming down 12 months in a row, in addition to the aggressive hikes of the market with the feds, I don't believe they're going to raise rates anymore, at least not for the next several months.
All right, sometimes we in the media do shorthand, and we do a lousy job explaining enough the whole idea behind the Fed strategy, which is to raise interest rates and slow the economy so it makes it more difficult for companies to charge more for their products. That's really shorthand, I understand. But the Fed's not there yet on the 2% inflation target it wants.
It wants 2%. I just don't see it happening. Here's the thing. Their goal is to lower unemployment, okay? No, excuse me, raise unemployment and lower the rates over time. The problem is they're not going to be able to lower rates aggressively enough to the point that we don't have a major recession.
Well, it seems like part of the problem is the playbook doesn't work. You know, we always talk in weather about how planners plan for the last storm. The storm that they're planning for in the past was a different kind of labor market. They keep, you know, in the past we would be seeing higher unemployment, and we're not.
No, it's the economy and the spending economy we have in the United States has stayed strong. Because of that, the economy is still doing really well. Now, wages are starting to basically halt now. They're not really raising rates anymore, and good salaries are not really increasing anymore. But in the same instance, we're not going to see a turnaround that we've seen in like 1970s or 80s, where we had stock market crashes because of this.
All right, we'll revisit this topic again, I'm sure, many times.
All right.
Ernie Burns, thanks so much.